Why were the Basel Accords created for banks? Have you ever wondered why banks operate under specific rules and regulations? The Basel Accords play a vital role in shaping banking practices worldwide. Let's break down the reasons behind their creation. The Basel Accords were established to create a consistent international framework for banking regulation. Their main goal is to enhance the stability and safety of the global financial system. In the 1970s and 1980s, the banking sector faced serious challenges. Major banks failed, and disturbances in currency and banking markets occurred. These events revealed weaknesses in banking supervision and a lack of common standards across countries. This situation contributed to financial instability. To tackle these issues, the Basel Committee on Banking Supervision was formed in 1974. This committee consisted of central bank governors from the group of 10 countries. Its purpose was to encourage cooperation among national banking regulators and develop international standards for bank regulation and supervision. The committee's first major achievement was the Basel Concordat in 1975, which laid the groundwork for future accords. The first Basel Accord, known as Basel I, was introduced in 1988. It responded to the need for a clear and standardized approach to measuring and managing credit risk. Before Basel I, banks were not required to hold capital proportional to the riskiness of their assets. This meant that banks with riskier loan portfolios could hold the same amount of capital as safer banks. This situation created incentives for excessive risk-taking, increasing the likelihood of bank failures. Basel I introduced the concept of risk-weighted assets. This categorized bank assets into different risk classes with assigned weights. For instance, government debt from stable countries received a 0% risk weight, while private sector loans had higher weights. Banks were required to hold a minimum capital equal to 8% of their risk-weighted assets. This capital was divided into Tier 1, which includes core capital like equity, and Tier 2, which includes supplementary capital. This framework aimed to ensure banks had enough capital to absorb losses related to their risk exposure. Subsequent Basel Accords, including Basel Roman II and Basel III, expanded and refined these rules. They covered additional risks such as operational and market risks, improved risk sensitivity, and enhanced overall risk management practices. Basel III, developed after the financial crisis in 2008, raised capital requirements further and introduced new regulatory measures to address liquidity and leverage risks. In practical terms, the Basel Accords have helped create a more level playing field internationally. They harmonized banking regulations and reduced regulatory arbitrage, where banks might exploit weaker rules in some countries. This promotes safer banking practices and contributes to greater confidence in the banking system. From a financial history perspective, the Basel Accords representing a key evolution in global banking regulation. They reflected lessons learned from past banking crises and the growing interconnectedness of financial markets. The Accords illustrate how international cooperation and standard setting can respond to emerging risks and changing financial environments to protect the broader economy.